Duratec Australia specialises in the protection and remediation of steel and concrete structures, and through the intelligent engineering of solutions, material selection and quality installation, they deliver the best solution to extend the life of your assets.
Yeah, I'm all good.
Speaking on behalf of the company, today we have Managing Director Phil Harcourt and Executive Director Chris Oates. A reminder to attendees that if you'd like to ask a question to our presenters, you can by submitting a question to the Q&A panel on Zoom. Thanks for joining the conference today, Phil and Chris. Over to you guys.
Good afternoon, and thank you for the opportunity to present. Duratec was founded in 2010 by Chris Oates and a fellow founding director, Dean Diprose. The three of us had worked together for a period of 16 years prior in a similar type industry, and then stepped out and set out in our own right. At that particular time, we sought a financial backer, and that was a civil engineering company called Duratec, and they provided financial support to get the business up and running. We had 48% shareholding ourselves. We put skin in the game, and Duratec had 52% ownership. It's been a considerable growth path from those early beginnings, and we've now established the business very strongly across Australia. And we got to a point in late 2019 whereby we could see that there was issues in terms of competing interests for finance from the point of view of bank guarantees, and with a combined bank facility, it became apparent that there would be a restriction in our growth if we didn't separate the businesses. So at that stage, we embarked on the IPO process and were successful in listing the company in November the 4th, 2020. Since that time, the business has undergone quite a considerable amount of issues in terms of COVID. We hadn't necessarily anticipated that impact, but when we look at the business, we have continued to grow and expand the business. As Banjo mentioned, our specialty is remediation and extending the life of infrastructure. And we do that in a very special way, whereby we have a technical team, which is like a mini consulting practice with engineers, and they are at the forefront in terms of early contractor involvement. So when a client has an issue with infrastructure, might be a high-rise building facade or mining infrastructure, we can send that team in to establish the nature of the issues that are occurring, and also the extent, and from that point provide meaningful layman's language report in terms of our findings and the options in terms of extending the life of that infrastructure. So that early contractor involvement assists in terms of de-risking the project for the client and also ourselves. So we're not going into the unknown with these conceivably high-risk projects. When we look at the business drivers, the drivers that support our business are aged infrastructure. All infrastructure ages over time, be it due to weathering or the service conditions it operates in. The other areas are building construction defects, and you've probably seen in the news many articles in relation to high-rise building apartments and some of the issues that arise through poor construction. We often get involved in those, but we also try and avoid buying into someone else's problem by the way in which we approach those opportunities. Asset expansion is another area, and we've recently been involved in wharf extensions for the Department of Defence, where they are now utilising longer vessels or will be acquiring larger vessels, and they need to be accommodated. One of the other areas of business drivers is as more assets get built, there's more work in terms of maintenance of those activities, of those assets in the long term. And the other area which generates business for us is with building code compliance. There's changes there, and one of the big ones at the moment is in terms of combustible cladding on high-rise buildings, where there's an absolute need to change out the combustible cladding to non-combustible materials. And that's where we're heavily involved as well. When we look at business sectors that we service, defence is a big one. It represents about 50 to 55% of our business. The other areas are buildings and facades, mining and industrial. The other sectors are energy, water and wastewater, transport, where there's bridge refurbishments, and marine and ports structures. Over time, we have increased our footprint. From 2015, we started up with a Melbourne and Sydney office, and we've now got offices in every state, every territory, and sub-regional offices. And it's important to understand that in each of those areas we have a regional estate manager who's responsible for business development, getting close to the clients in his particular geographical area, and forging long-term relationships. A lot of our work is self-performed. We also engage specialist subcontractors and also project manage subcontractors on a lot of our works. So we've got very much a national presence on that map. You'll see the locations for Duratec. We've also got in the terracotta colour the DDR locations, which is a joint venture we have with a Northern Territory Aboriginal business, and we have 49% shareholding in that, and that is doing extremely well in the government sector, whereby there's a strong focus on IPP, engagement of Aboriginal companies, and a big focus on increasing the spend with those businesses. Just looking at the shareholding, the current share price, 40 cents. It's obviously lower than we would like it to be, but it provides our market capitalisation there of 96 million at present. The board and senior management, Gavin Miller's or currently works for Duratec and was on the original Duratec board. And we've got Martin Bryden, who is a non-executive chairman, very ASX listed company experienced, having worked for Coburn Cement in the past. And he also serves on the board of Fletcher's in New Zealand. So very solid and experienced board. Looking at the financial results for the first half of FY22, a pretty disappointing result, heavily impacted by COVID. The shutdowns in eastern states, particularly New South Wales, ACT and Victoria, impacted us considerably, and such that many of the projects, or in fact all of the projects in those regions, were shut down whilst we were still carrying the operational overheads. Revenue achieved slightly up on the previous comparative period. Margin down as a consequence of carrying those overheads on the other projects, and EBITDA also down. What has been good has been the cash position that's strong, and the order book, which sets us up for a very good performance coming out of COVID in the latter half of FY22, and also heading into FY23. So that order book also includes 49% of opportunities for that have been secured for our Aboriginal business. Tendered volumes, we've seen an increase across the board in all sectors that we operate. Very strong pipeline of work coming up in this business, and as I say, with normal operating conditions on becoming clear now, we see a very good performance coming up. That's just a financial comparison between FY21 and 22 half-year results. As I said before, in terms of FY21, the big impact was all those local government areas that were shut down, impacted our ability to operate in New South Wales, Victoria and ACT. But even with that, we've managed to increase our footprint in opening offices for opportunities in the likes of Katherine in the Northern Territory, in Tasmania and Hobart, and also with Gladstone, where there's a serious need for good remediation companies. Got a strong balance sheet. We have very low demand for equipment. Our capex spend is probably likely to be around about the 6 to 8 million. So low capital costs for the business. And as I mentioned earlier about bank guarantees, one of the things we found with our current bank facilities was that it impacted in terms of some of the bank covenants. So we've had the leverage ratio, which is total debt over rolling 12-month EBITDA. We've had that adjusted because the bank included bank guarantees as debt. So that was too restrictive, and we've negotiated a good position out of that. Despite the poor half-year result, we've declared a half-year dividend of 0.5% per share, and that's really portends, in our view, our confidence of second half performance and going forward. In terms of our outlook, if we look at defence segment, very strong growth in that area. There's a big concentration of spend, and we operate very much in the sustainment area. And by FY30, they're looking at 24 billion in terms of spend. So no shortage of demand for opportunities in defence. We look at mining and industrial, and there's certainly no downturn in that, quite the reverse. And we're very well positioned in terms of operations in the northwest of WA, the goldfields, and northern Queensland. Buildings and facades, very topical area, and we've got 10 large projects afoot. The biggest one is a $63 million project in Perth, Central Park, and there's still strong demand in that sector. Fuel infrastructure, we've recently had some very good announcements in relation to that, with Western Sydney International Airport. We're doing the ring main pipeline for that as we speak, and we've also secured for defence up at Tyndall, RAF base, a fuel infrastructure project there, which is circa 100 mil.
Phil, we're running a bit thin on time here. We'll move on to some questions.
Yep, sure.
We've seen other contractors such as Decmil and Macca struggle to make money in the current environment or suffer from delays between projects. Can you help us understand why Duratec is different?
I've had, if you want, Phil, I've been reading these questions, so I can jump into that one if you want to sort of make a couple of notes. Yeah, so just the difference between Decmil and Macca, like where most of our senior managers, or our senior management team, is a strong ownership. So there's we have key drivers. I'll probably just talk about drivers there. Some really key drivers for success, and that's we've got performance rights at about probably 40 to 50 senior managers. So they're motivated very strongly to increase the share price. And we're all invested. We've all worked together for probably 15 to 20 years. A lot of us have. So that's another strong driver. We're also a specialised maintenance company. So you look at the margins we achieve, and it's something that point out in the 4D that we recently put out. Our average gross margin on jobs is between 17 to 19% generally. We were down at about 16%. So on a lower revenue. So we were expecting to grow the business strongly. We did have a few delays on awards, but now we're into those jobs. So that's the ones being listed, which is like the Central Park, Tyndall, WSA. So for us, where we're different is we're really going to get that high gross margin. We've got stable overheads. And so when our revenue goes up a bit and we get back to those margins, it does flow down. So we are definitely different, and we're geared differently as well. We'll make the point too that we're a specialised maintenance company. So we're not into, we do construction, I've got to say, but it is specialised construction generally for defence or fuel infrastructure. And it only represents probably 20 to 30% of our turnover. So the rest of it is really ongoing work. And so we are definitely different. And something that we talk about is our ECI. So that's our early contractor involvement. And that's where we get involved, where the client spends. And just to use an example, Central Park, they spent $1 million with us up front to understand the project. And we effectively negotiated a $63 million project on the back of that. So that just gets us into a space where we understand the structure very, very well. We understand the risk, we understand the costing, and then we basically negotiate our outcome. That's what sets us apart. So that's a $63 million job that we use our ECI model. So we're definitely different to those general construction firms. I'll just roll into another one too, by the way, is inflation and the rising order book. So we do win better work. Our inflation's controlled. It's everywhere, by the way, the cost of labour, the cost of stuff, the ability to get it. But we do, a lot of our jobs are short-term by nature. So they operate around the 6-month mark. So where most of the work we have won is in that rising inflation market. So if you look at us a year ago, say, around the circa 113 million order book, and then we grew it. So when we grew it, though, we were in that, we understood where we were. A lot of our contracts also have rise and fall. So all that ongoing work with Rio, BHP, Newmont, all of that is rise and fall. Every year we adjust our rates. So we are very aware of it, and we do control it quite well. Phil, did you want to add anything? I don't know if you can see the questions there, but that's a couple of them that have come through.
No, certainly that we are totally different. As we mentioned there, the ECI completely separates us from the likes of Decmil and Macca. And we are right in amongst it, forging a long-term relationship with that client, gaining their confidence and de-risking the project. So instead of bundling into a project and finding latent conditions, we discover those as much as possible beforehand and price accordingly.
Thanks a lot, Phil and Chris. Unfortunately, that's all the time we have today. Appreciate your time and thanks for joining the NWR conference.
Thank you.
Thanks very much. Thanks for the opportunity.
Thanks a lot, guys.